You're listening to Ask the Expert on Sprott Money News.
Hello and welcome back to this month's Ask the Expert here on Sprott Money News. I'm your host, Jeff Rutherford, and on the line with me today we have Mr. Bob Thompson. Bob Thompson is regarded as one of Canada's leading authorities on alternative investments. With over 16 years at Canaccord Genuity and 19 years in the business, Bob is recognized as an out-of-the-box thinker, developing award-winning investment and financial strategies for clients. As a focus, he has become known for his insights on the precious metals sector, especially the underlying fundamentals that are often overlooked by others, and the strategic allocation of placing precious metals and the stocks related to them in investor portfolios. His perspective and insights on the market have been featured in the Globe and Mail and the Financial Post, and he is a popular guest on Business News Network Television and CBC News. And with that, we'd like to welcome Mr. Bob Thompson. Bob, thank you for joining us today.
Thanks for having me on, Jeff.
Excellent. So, Bob, I guess the first question I have is kind of a personal question of mine before we actually get into the questions from our listeners. And from my perspective, most financial advisors don't tend to be very pro-gold, let alone very big on physical precious metals. And even for yourself as an author of a phenomenal book called Stock Market Superstars, Secrets of Canada's Top Stock Pickers, with a heavy focus on precious metals. So I guess my question to you is, why have you chosen the path less chosen in the financial advisor world as such?
Well, I think a few reasons, Jeff. And one is that precious metals tend to move differently from other assets. And in the last few years, they've moved opposite and they've moved down. But that's created some fantastic opportunities. And when I did my book, Stock Market Superstars, I realized that people that are successful in this business are people that read the same information as everybody else and to derive a different conclusion. And that's the only way you can be successful, because if you think the same way as everybody else, you end up the same as everybody else, which is mediocre. So I love the fact that people generally don't like gold, because that creates a huge, I think, difference between value and price, and especially in the stocks, and we can talk about that more.
Excellent. So moving on to the questions here from our listeners, Bob. So the first question is, so many financial advisors are now promoting insurance for low risk and tax avoidance. Is it a good time to invest in insurance companies for medium-term growth?
First of all, as far as insurance companies and stock prices, they tend to do a little bit better when interest rates go up, and that's a function of their liabilities and their long-term obligations that they have. Also, insurance companies, by investing the proceeds of the premiums coming in. So if they have a good investment manager, if interest rates are higher, they tend to do okay that way. So from that perspective, insurance companies do all right in a rising interest rate environment. And unless interest rates go hugely negative here, we're probably going to see that down the road. But I think the overriding factor as to why people are promoting a lot of insurance products right now is because interest rates are lower than they've been, and I'll repeat this, lower than they've been since 1780. So for 234 years, interest rates have never been this low. And where I get that information is measured by 10-year U.S. government bond rates. And believe it or not, I guess in the 1800s, late 1700s, the U.S. government borrowed money, and the rates have always been higher than they are right now. So we're in totally uncharted territory. Everybody's racing to try to find something that's going to give them some sort of constant cash flow for their retirement down the road, and that's a big issue these days. So all these new products are popping up.
So Bob, moving over to a question in regards to equities, our listener wants to know, do you agree that equities are overextended and ready for a big correction? And if so, is it true that those who own property and precious metals during the Great Depression were impacted less by the financial strife of the time?
Right. By many measures, U.S. equities are very, very overextended. And that's just a fact. And a lot of people are saying these days, well, it's different this time. And as you may know, that's the worst thing you can possibly say in the financial industry, because things are never different this time. But people saying things are different because interest rates are so low and there's so much money printing, and it doesn't matter anymore that the market is higher than it was or as high as it was in 1929 and the end of 1999, as measured by Schiller PE ratio, is measured by lots of different things. And one of Warren Buffett's favorite ones for measuring the market is the market cap, the total market to the GDP of the country. And, you look at that and it's trading at all-time highs, or the same as it was during all-time highs in the past. So that's important. And I think we can honestly say that there's not value there. But that doesn't mean the market's going to drop really quickly, because that can stay for a long period of time. And I think the most successful investors, whether it's precious metals investors or whether it's stock market investors or bond investors, tend to look for value. In other words, you look for something that the expectations are low and the value is higher than the price on the market at any particular time, and that's how you make your money. So based upon that, yes, the U.S. market is overextended. That doesn't mean it's going to drop. It might go higher, but usually in overextended circumstances, when the correction happens, it's pretty severe. Whereas if you buy something that is extremely low in value, that's hated, and the expectations are very, very low, your downside is usually very low, and your upside is very, very big. And, I think that's where we stand right now with precious metals equities in particular. If you look during the Great Depression, precious metals equities did well. Obviously, they were all different companies than they are today, but they did fairly well and were a great diversifier for people. When people lose confidence in the financial system, as they did in the Great Depression, the financial markets were down quite a bit, and precious metals held their own. I could probably talk for several hours on that question there, but what's hugely exciting, really, to me right now is, other than the normal allocation that somebody should have to precious metals, I think people should be getting really excited about it right now, especially on the equity side, because you look at things like the junior gold index. These are not penny stocks. These are good quality, billion-dollar market cap companies that are producers. That index since 2011 is down 80%. How many indexes in the world are down 80%? And when you look at it, that creates, I think, a tremendous amount of value. When an index is down 80%, some of the components can go to zero. I mean, that's always the case, so you got to be careful if you're going to pick an individual company. But when an index is down 80, generally speaking, your downside is very limited, and your upside is, can be hundreds of percent just to get back to where it was. That's the kind of trades that I like, and I like it when everybody laughs at me and nobody pays attention and everybody runs in the opposite direction.
Very good point, Bob. Very good point. Now, another issue or concern that is very common amongst our clients and our listeners as well, too, is the idea of government confiscation of metals. So the next question is, for someone who's trying to do some strategic planning, so as a part of planning of the strategic allocation of precious metals, what jurisdiction is safe from possible future Canadian or American law ordering storage providers to turn over the gold or silver holdings of their clients? Since, for example, Brinks is headquartered in the U.S., could the government order Brinks to comply with a new law in their worldwide facilities?
Well, I think under your pillow is always safe, unless it gets stolen.
Exactly.
But outside the banking system, we've heard about is a good thing, and I think that's going to be a pretty safe environment to be in. The government can always change the rules at any time, and let's go back to the Great Depression. Roosevelt said, when he realized that gold was competing with the currency, said everybody must turn in their gold. They didn't have a lot of storage facilities, but I've seen these pictures of lineups and lineups of people around the block with gold in their hands to turn it into the government and get $25 an ounce, of which the government devalued the currency a few months later and made it $35 an ounce. So that was a great trade for the government. But I don't think you could really do that today. It would be tough. People did exactly as they were told 80 years ago. I think at this particular point, people are going to say, no, you can't have my gold, and that's obviously going to be an issue. So can they change the rules? Yes, they certainly can if they get desperate enough. With a global economy and how much things have opened up over what they used to be, would that be feasible? I would hesitate to think that unless things got absolutely desperate enough. So outside the banking system, probably a relatively good place to store the money.
So, Bob, another concern I think that has recently come up, because as we're looking into the news, and there's been a lot of talk about capital controls. So one of our listeners wants to know, many believe that as the economy begins to seriously decline, that the U.S. will institute severe capital controls. where we are already hearing talk of outlawing cash and making all financial transactions electronic. Surely gold and silver would be outlawed as well. Under these conditions, what is the future for those who hold physical gold and silver? The government can make these laws, as we just discussed, but can they enforce them?
Well, I think it's interesting. The biggest holder of gold in the entire world is the U.S., and they haven't sold their gold over the years, and they don't talk about doing it. So on one hand, they say, gold is a barbarous relic, and on the other hand, they say we're going to hold all our gold because it's important to keep this. So I don't think that they will outlaw gold and silver. I mean, it's something that has always been a store of value, and it's going to be there. But I will say, and I think if you're going to be a good money manager, you have to know your history, you have to know philosophy, and you have to know psychology, because those are the things that move markets, and things maybe don't repeat themselves, but history does rhyme. So let's go back to what Paul Volcker said in the late 70s. He was the Fed chairman, and he's probably wasn't that liked at the time, but now is regarded as a hero in breaking the back of stagflation, which happened in the U.S. And, as a lot of the listeners may remember, gold went up by about 700% in a few years in the late 70s because of inflation. So Paul Volcker actually said at that time, when asked what he could have done better, he said we should have controlled the price of gold more than we did. He said, because during times of financial crisis, gold starts to compete with the dollar, and you cannot have the gold competing with the dollar. And he actually said gold was the enemy. So it was very interesting. I mean, he's on the economic councils today, and he still gives advice to people. So he also said, and a lot of things won't change, and as you know, politicians won't change, governments won't change anything unless they absolutely have to, unless they're forced to do it. So all the events leading up to '08, a lot of people could see that happening, but nothing happened until it had to happen, and there was a total catastrophic financial collapse. So they aren't going to do a lot until something really, really bad happens. There's been no recessions forecasted going forward, but when that happens, obviously they're going to have to take some initiatives. Important, though, I think, to realize, again, going back to that time, is in the late 70s, obviously they said gold was the enemy. In the late 90s, when, again, it started to pick up at the credit, Greenspan said, we will be willing to lend our gold out as much as possible in order to keep the market price in line. But I don't think the government will do anything until they absolutely have to, and hopefully people have their gold by that time. But I will say, remember, the government always bends to what the consensus wants, right? So if 99% of the people are suffering, obviously because of a financial crisis, and 1% have who have thought ahead and own a lot of gold and are doing well, the 99% is going to not want the 1% to survive, right? They're going to want they're going to want a little bit of that. So you got to be careful with the gold and silver. There's 100 things that can happen going forward, but own it, hold it. Try to keep it outside the banking system and have it as a percentage of the portfolio.
Yes, how apropos. That's another question that I'm always posed to by clients, and that's a question I can't answer because I'm not an advisor, but you are. So here's the question. The question is, what percentage of one's portfolio should they invest in precious metals, and how should they invest in this sector? Is it through stocks, physical metals, or ETFs? What are your thoughts on that, Bob?
I think that's a fantastic question. People look at allocation, not just to precious metals, but to anything, most of the time in completely the wrong way. How people look at the allocation is, well, should I allocate to this because it's going to go up in the near future? And honestly, the value, the fundamentals could all point towards something doing well, and it doesn't for a year or two or three, whatever the case is. People are constantly frustrated because they're chasing things that are going up and getting out of things that are going down, and it's not just with precious metals. So how do we make an allocation, and what do we decide is a good allocation to precious metals then? That's up to the individual, but probably 10-20% I think is not a bad allocation to precious metals. Then what you have to say is you make a strategic allocation. And what I mean by a strategic allocation, that's kind of a top-down allocation where you say, let's say, and it depends on the investor, depends on their portfolio, how much they have in art and real estate, and what their retirement situation is, and all of that. So there is no perfect answer. But let's say they wanted 20% of their money in precious metals. The strategic way to look at it is, okay, if I have 20% of my money in precious metals and gold doubles in the next 2 years. Well, now I have 40% of my portfolio in precious metals. I don't want 40% in precious metals. I want to sell that and bring it down to 20% again. On the other hand, let's say if we have 20% in precious metals and gold or silver goes down by 50%, now we only have 10%. When you reevaluate, you say, no, that should be 20, so let's double up and bring that up to 20. And if you rebalance and do this strategically over time, it takes away that decision of what's going to happen in the next few months. Is this asset going to go up or is this asset going to go down? And that could be the same thing with U.S. equities, it could be the same thing with global equities, whatever you want. Come up with this strategic allocation and rebalance back to that allocation. And miraculously, it takes away the emotion because you end up buying more of something when it's down to bring yourself up and selling it when it's up to bring yourself back to your strategic allocation. And that's not how most people look at it, but that's how people should look at everything as far as their portfolio is concerned. I think the next question was, should we look at stocks or metals or ETFs?
Exactly. What vehicle or vehicles do you think are the best ways to invest with precious metals?
Right, and that depends upon the time. So sometimes I can pull this up on Bloomberg, and I do frequently, to see the value differentiation between gold stocks, for example, and gold bullion. And there is a ratio. There's a ratio for everything in the world in the financial markets, as you know. So there's a ratio for that. And at certain times, it shows that stocks are very, very undervalued, and certain times it shows that metals are undervalued compared to the stocks. So going back to late 2007, the stocks were overvalued compared to the metals. Same in 2011. So if you had your strategic allocation and you said, I want to have 20% in gold-related securities, you probably would have added to your bullion at that time. At certain times when we've had a bear market, the stocks go down a lot more. Now, right now, gold, as many of the listeners know, is down about 40%, 37-40% from its highs of 1920. I just mentioned that the junior gold producers were down 80% in value, and that always happens in a bear market. So in that particular case, I would have some more of my money into the gold producers. Again, not necessarily individual ones, because we're in a tough time right now. You never know which ones are going to survive. But as far as the index, they can have a big rally. They can be up 100%. Then you rebalance and you say, let's have some more bullion in the portfolio. So that's kind of a strategic way to allocate within your strategic allocation. As far as ETFs, there's ones that companies have that are completely 100% backed, and you can get your gold. If you sell some of the ETFs, you can get the gold delivered to you, and those ones are all safe and sound. Other ones don't really have a lot of backing, or are kind of backed by paper, and I would stay away from those ones. So physical is easy. The stocks are fairly easy to see when the valuation is over or under, and the ETFs, you just have to examine each one individually.
So moving along, Bob, again, another concern of our listeners, that is a possible financial collapse, which is obviously why a lot of people have turned to gold as a way of securing their financial future. So I guess the question is directed to you personally. Do you predict a coming collapse of the financial markets? If yes, when do you see this coming? And likewise, can you explain the potential triggers for the financial collapse?
Right. So if I could answer that, I would be worth probably the richest person in the world, and a lot of people would be, because the question is, and it's a very legitimate question, it's what people ask, but it is, what's going to happen? How is it going to happen? And exactly when is it going to happen? And nobody knows that. You can see that something's going to happen. A lot of people were calling the financial crisis starting in 2005, including Eric Sprott, started writing about it in 2005, how the banking system was over-leveraged, et cetera. And it took itself 2 or 3 years to actually manifest itself, which actually was a fairly short period of time. So nobody knows when it's going to happen. But to say there's going to be a financial collapse, sure, there will be. But I want to say that it depends upon the definition of a financial collapse, because collapses happen all the time. And I know a lot of listeners are from North America here, and we're kind of centric on North America, but I love when collapses happen, and collapses are happening everywhere in the world at all times. So the Japanese market collapsed, and it's up 100% from its bottom 2 years ago. Right? Gold has collapsed recently, or gold stocks have collapsed, and that's a recent one. But the U.S. market collapsed in 2009. Europe had a financial crisis in 2011, and markets collapsed down, and they're up significantly since then. The Russian markets collapse from time to time. I'm not saying to go buy the Russian market, but these significant rebounds happen. So our latest collapse, so it depends upon what we mean by collapse, because collapses are happening all the time. Our latest collapse has been in gold and gold stocks and silver and silver stocks. So that's where you go and look, and you might not be rewarded immediately. But again, let's go back to 2000. Was there a collapse? There was a technology collapse, and the NASDAQ market dropped 75% in value. So everything's correlated more these days. In other words, it used to be where the Asian markets would collapse and we'd be fine here. And everything tends to be all interconnected today, and I think that's what the scary part of it is. So when an incident happens, it drags everything down in the short run, but that creates value that you can see. And an interesting statistic here is we've had, in the last 7 recessions, which takes us back decades and decades in North America here, you know how many recessions the central bank has forecasted of the last 7 recessions?
How many?
They have forecasted 0 of the last 7 recessions. So to look at what the central bankers say or what economists say about what's going to happen is ludicrous, really, because recessions happen when they happen, and they happen with a business cycle. So looking forward for the next 10 years, once again, nobody is forecasting recession ever to happen. And that when the recession happens, that's when all this stuff is going to manifest itself. 2008 had its incidences. There were specific events that happened because of that. Next time it'll be something different, but that's what you have to protect against. That's what you have to have insurance. And I think gold is a good insurance policy. And I always say to people, what if you go buy car insurance tomorrow? Do you want to go get in a severe accident the next day? No. You would rather you not have an accident in your car. And you would rather that whatever your money you paid on car insurance, you didn't actually have to use it. So have the gold, have it for a percentage of the portfolio, which is fantastic. It should be there. It'll help to protect your portfolio in bad times. When a financial collapse comes, which it will, because it's happened so many times in the last 100 years, you can't even count them. So have it there. Don't say it's going to happen in 6 months or a year or 2 years, because if somebody tells you that and they're right, it was more luck than common sense. Nobody knows timing.
Amen to that, Bob. So kind of what ties into what you've mentioned, I believe you kind of touched upon it already in terms of, preparing for this sort of collapse. So how are you personally preparing for economic uncertainty? Are you preparing by storing food, water, precious metals, etc.? What's your take on that, Bob?
Well, I'll give you an answer to that. And I live in Vancouver, Canada, so I definitely store water and food because an earthquake can hit here anytime. The big one's supposed to happen here sometime. Right. So that's one good reason to store. Another reason would be, obviously, yes, if there is some sort of liquidity crisis or financial collapse, yeah, you want something that is substantial that you can hold on to. And precious metals are great for that, something that can help you survive for a while. And I'm not saying there's going to be some event here which that's needed, but again, treat it as insurance and say, if I can have insurance, what amount of insurance can I own that's going to make me feel comfortable? And I'm not talking about buying a financial insurance policy. Again, insurance could be a certain amount of precious metals. It could be food or water or whatever you need. And then say, this is great. I'm going to have it there. And if I need it, fine. If I don't need it, great. I don't know when I'm going to need it. So I just have it here all the time.
So lastly, Bob, let's talk about a topic that's kind of been hot, I guess, in the press in the last couple of weeks. And likewise, Eric and I have been discussing it within the weekly wrap up as well, too. And that's BitGold. We can see in the news, there's been an acquisition that BitGold has done. They've bought out Gold Money, James Turk's company, and merged. So that, for a company that just started last week, that's a very big move and a good move for them, I would think, as well, too. So what do you think of BitGold? Do you think the recent share price run-up is merited? Where do you see the share price of this company heading in mid to long term?
A couple things to that answer. I guess for full disclosure, I've traded this for clients in the past week and done well, of course, because it's gone up in price. But it's very, very difficult to value business business. And I think as far as your listeners need to know about investing, sure, Bitgold is a good company. It had an acquisition. The market cap of the company is $200 million. The acquisition today was $50 million, so it's about a quarter of the size, and lots of good fundamentals for the business. There's always risks when you grow. People start to see that you've got a good idea, and competition comes in, etc. I'm not saying that's going to happen in this case, but we have to make sure that you are getting value for the growth that the company is going to go up. And I'm just going to go back 15 years here, and then I'll come back to Bitgold. Technology in the late 90s. There was lots of great companies there which had good ideas, which have turned out to be really good companies, good earnings growth, grown their businesses, done extremely well, fantastic businesses. And then people say, oh, wow, I should have invested in that because I would have made money. And I'll say, no, because you paid the wrong price. Right? Usually when somebody's racing into something, it's good to just sit back and have a level head. Don't start fighting people for things that are going up in price, because what happened in the technology stocks is you might have owned a really good company, and here we are 15 years later, and you haven't got your money back, but you owned a really, really good company. So owning a good business and making money in the stock do not necessarily go hand in hand. So with Bitgold, great business, good acquisition, probably going to be a company that gets bigger and bigger over time. Just make sure that you pay the right price and don't start fighting people to buy, because for every buyer, there's a seller.
Very well said, Bob. Well, Bob, we'd like to thank you for joining us today. Again, we've been speaking to Bob Thompson at Canaccord Genuity, and we urge our listeners to go to bobthompson.ca. That's BOBTHOMPSON.ca. And again, if you have any questions or concerns, please contact Bob, and I'm sure he'll be able to help you out in any way he can. So again, Bob, we'd like to thank you for joining us here today on Ask the Expert.
Thanks. It was very enjoyable, Jeff.
And to our listeners, thank you for listening. This is Jeff Rutherford for Ask the Expert here on Sprott Money News. Have a great day.